Okay guys, hi. So we in the first video we discussed how we would get all that information into our subsidiary books. Now the next bit is to see how we get that information from our subsidiary books into our general ledger where the T accounts lie. So we want to get the information from here into here. Now one last thing we didn't talk about when we were finishing off our subsidiary books was that bit at the bottom here, where it tells us that you have this closing inventory here. This is on the 30th of June. You have this closing inventory at the end of the month, and we'll deal with that when we start preparing the T accounts. Because I want to talk about cost of sales, but not before we start talking about T accounts. Okay, so let's get the information in there. So let's just go through it step by step. What do we have? So we have this information that we put in the general journal. So what do? We need to get this information from here, if you like, into the general ledger. So what two T accounts? We need capital and we need the bank. I don't know, I'm just a bit pedantic. I like things just looking sort of, even though it's not that important, just merging everything and making it look good. So I'm just going to put the numbers in, the detail, just because of time. So what are we saying? The capital account has received £1,000 and the bank account has received £1,000. So really the detail is capital. Always use the opposing detail, and bank. I'm not going to use any dates anymore. I'm just going to take the information, put the detail. And there you have it. That's the double entry. Debit, bank, credit, capital. That's the very first one. Right. Then, well, you could use the original data again, but you have the information here. So I want to deal with the subsidiary books first. The credit subsidiary books first. So let's look at the purchase date book. You have a total of 1,550. So what we should be doing really is opening up a purchases and a trade payable. Yes. And so let's merge this as well. Make this look pretty. And let's merge this as well and make this look pretty. So what do we have? We have purchases. I'm just going to go back and pick the figure up, just using, I guess, the function of Excel. Excel is able to do that. And same thing here. I'm just going to go back and pick the figure up from here. Yes. So what do I have here? I have purchases for my detail, and I have trade payables for my detail. I can just sort of enlarge this and enlarge this. And so I guess you can see it again. Debit purchases, credit trade payables. And what do I have next? So the next subsidiary book that we deal with, of course, is the sales day book. So I go in here and I make my sales or income. Same thing. Income, revenue, sales. You feel free to, but really we should be using revenue, but for now it's okay. Trade receivables. Okay, right. Again, I can just go back and pick my numbers up. I'm interested in totals. Let me highlight this over and over again. I'm interested in totals, not the individuals. We just want to find out if we made a profit or not. And then, of course, we trade receivables. This is the double entry of these numbers. Yes, this is the double entry. Receivables. Okay, right, good. So let's look at what happens next. So we then have some returns, don't we? Yes. So the first set of returns we look at, if you like, are the purchases returns. So someone's returned, we've returned goods worth 180. So purchases returns, and we weren't happy with those goods, and the goods were worth a total of 180. Well, that means that we don't owe the trade payable people as much as we started with. And that's purchases returns. And that's that. And then the final subsidiary book, the final credit subsidiary book, if you like, is the sales return. I've got purchases returns. What is that? That's purchases. And then here we have sales returns. Let me do that again. Let's just make that look pretty. And what we have here is we have that coming in from there. And that's just 50. So it's not too bad. 50, and we go to trade receivables. So we have sales returns. And we have 50. Pretty good. So we've done, if you like, all the credit movements, so to speak. Now we need to go back to the last subsidiary book that we're dealing with, and that's our cash book. Because this is a source, this is a subsidiary book. Stuff has happened. We've dealt with capital. So we can do, it doesn't matter what side, just go through one side and just go through it date by date as you wish. Let's just go through it in terms of receipts. Let's talk about what's happened. So, in terms of receipts, we have received a total of £600 from our trade receivables, haven't we? Yeah, that's what's happened. We received a total of £600 from our trade receivables. You can see it in the corner. Oh, is this not showing, allowing us to see what this? Oh no, here we are. Can you see it? That's a total 600 over there. So we have received 600. So 600 is coming to the bank, and if you like, reduced our trade receivable. Great. So our trade receivable is, let's go to the bank. We have received £600 from our trade receivables. And here we are. Bank. 600. This is just a reference telling us where the other information is. So we sold some goods on credit. We are owed 860. We returned some stuff worth 50, and we have received £600 from the people who owed us. So the difference must be the amount that they're still owing us. Let's do the same for what we have paid. Let's go back to our subsidiary book. So I'll come back to these earlier ones, but since I'm here, let's just focus on our trade payable people. So we're talking about Liam, Zee, and Jenny, aren't we? And the total of what we have paid out is £900. Right? That's what we've paid out to these trade payables. So that's £900. Let's deal with them first. So 900. I'll just use it. I'll just yellow them out. 900. So let's go to bank. Trade payables. 900. Then I'll come over here. Bank. 900. This is the double entry. All the double entry starts here. Yes, in the T accounts. Okay, now going back here. Now that we've done that, let's deal with all the others. So carriage inwards, carriage outwards, we need to make their own separate T accounts because we need to do the double entry for them. Yes, the double entry hasn't occurred just yet for them. Carriage in. Let's see, is there in there? Okay, right. Let's make some. Carriage in. Carriage out. Wages. Rent. Electricity. And those are the three ones there. So what is the double entry relating to these? Well, wages 100. Let's deal with that. So wages 100. What do we do? The double entry. If I had just given you a double entry exercise, you'd just have said, well, in simple, debit wages, credit bank, and that's exactly what you do. Debit wages. I could pick it up. I could pick this information straight from here. Yes, I could pick that information straight from there. Debit wages. And you can see that my bank account, my bank T account, looks exactly like the cash book. I mean, it is the cash book. I've hinted many times in the fact that many organizations just use their cash book as their T account and don't even bother. They just put the other side in the corresponding expense account. They don't even create another whole new bank account. Anyway, let's just do this. Electricity. And rent. And so, what do we have here? We have electricity, let's bring that in from here. Electricity is 50, and rent is 20. Good. And so we have electricity and water. That's the label bank. Rent 20. Bank. Okay, right. So that's what we have. So far we have dealt with all of these. Oh yes, let's deal with carriage. Carriage inwards and outwards, 20 and 30. Let's deal with that. Carriage inwards, 20. These are all expenses. Outwards, 30. Let's go to bank. Are they in bank? Let's make sure they're in bank. No, here we are. Carriage in. Carriage out. 20 and 30. Very good. And those are the key ones. Now the last one we talked about, of course, was these discounts. We have given a discount of 35. We have received a discount of 70. So the discount we have received is in relation to these trade receivables. We have given a discount. We've pretty much said, you know what, don't pay us what you owe. Pay less. So let's look at their T accounts. Let's look at what we're saying. Here we are. Let's go to the trade receivable. We're saying that we sold these goods to you on this amount. Well, don't pay us this. Pay us less. So we have given a discount. So we have discounts allowed, reducing what the person owes. If you don't do that, the trade receivable will keep showing that this amount is owed to you. So that's not the case. You have allowed a discount of 35, and so you need to open up, because there's double entry, you must open up a discounts allowed account. It's an expense account. Discounts allowed, 35, trade received. And the same thing, we have a discount received. Yes, and that's for 70. Yes, and that's for 70. And the same situation is here, but the reverse with the trade payables. You had to pay a certain amount here of 1,000. The person said, oh, you know what, just pay 900 and you can forget about the 70 here. So that's what's happening. And voila, we're pretty much almost done. Now, we talked about this idea of cost of sales, a big idea really with cost of sales. We said that in order to find out what the cost of this income is here that we have made, because we bought this, just because we bought goods worth at 1,550 doesn't mean we sold 1,550. First of all, we have purchases returns saying that, well, actually, some of the stuff you bought got returned, but even still, we still have some stuff probably sitting around, and we're given that information. We're told that we have some closing inventory. We only know about this at the end of the period. So we go in and we count our closing inventory, and the question tells us that you have closing inventory worth £700. So what do? We have closing inventory worth £700. Yes. Closing inventory was £700 because we will open up what's referred to as a cost of sales account, because we need to find out what is the cost of what we've actually sold. And on the opposite side we have closing inventory worth £700. So that's the double entry for that closing inventory. Debit closing inventory because it's a new asset that we have, and credit cost of sales because we're going to be taking it off purchases. We're going to do the transfers in a second, but that's sort of the thinking. I've just done this one a bit early. Remember that, as I say, to even do this, for me to do this, I must put it in somewhere. It must come from here. So I need to write it in as a journal in my subsidiary books. I'm just going to, just to make things faster, I'm just going to copy that. Paste. Okay, so let's just do it manually. Doesn't like it, that's fine. Debit closing inventory and credit cost of sales. $700. Yes, and that's what we're saying. Being closing capital for the period. Being closing inventory. For the period. Right, so there we are. So we have now transferred, well, we've got all the information in there. And what we'll do is, let's transfer everything very quickly within this video. I was going to say we could stop and take a break, but you can just pause it. Let's create our final T account called the income statement, and let's get all the information from here in there. Remember again, the purpose of preparing the income and expense accounts are to transfer the information to the income statement T account. That's what we're trying to go. We want to get all this information out, things like purchases, because these are income statement accounts, aren't they? These are I's and E's. So I'm going to leave that up to you to finish, but the key point here is this: transfer. The first thing I do is I transfer purchases to my cost of sales. 1550. So I credit purchases and therefore debit. I have purchases here and debit cost of sales. That's what I'm going. That's where I'm going with this. Sorry, forgive me. The next thing I do is, well, this is capital, this is an asset, this is a liability, so I don't touch these. These are going to get brought down. I want you to do that. Just look at my video on the cash book that we've just done and bring those down. Make sure you know how to do that correctly. Revenue, we transfer straight to the income statement. Transfer to income statement is 860 here, and take that straight to the income statement. Revenue 860. Yes, and so now, and let's just get through, let's just do a few more. But the key point is, transfer this to the income statement. This, of course, gets transferred to the cost of sales because we want to know what the cost of the goods that we had sold. So remember, we talked about cost of sales. We needed to include purchases, returns, carriage inwards. Is transfer to cost of sales. Debit purchases, returns, 180. If you're debiting purchases, returns, you must be crediting the cost of sales account. Every debit has a corresponding credit. Purchases, returns. But don't just take my word for it. I mean, look at what's going on. It must be, because purchases, returns must be on the opposing side as purchases. It must be, as because I'm reducing what my purchases were for that period. 180. And who's next? So we've done this, we're happy here. We'll transfer sales returns. We'll go straight to the income statement. Transfer to the income statement. 15. Returns. And 50. And then, so that's done. These two are done. Who is next? Carriage inwards goes to the cost of sales account. 20. Carriage in. 20. Carriage out goes straight to the income statement. That is an expense on its own. 30. So debit carriage outwards. Sorry, credit carriage outwards because I'm taking it out of there and I'm putting it in the income statement. Debit carriage out. 30. And then let's do the same. We do the same for remember now, this is an asset account. Closing inventory is an asset. We just bring it down. It's an asset. I keep highlighting that, please. It's an asset account. So don't start bringing that. You've done the double entry already into the cost of sales account. This is an asset. You have it at the end of the period. Yes. And then you have your wages. Take this wages again. Transfer this to the income statement. 100. Transfer this 100. So credit wages, debit income statement. 100. Electricity transfer. 20. Electricity. 50. Oops, sorry, that was rent 20 and electricity 50. So then I'll just do both now. Transfer 50. Rent 20. Almost done. So that's that. Closing inventory gets brought down. You can see all these are closing off. All these expenses accounts. They're done now. Discounts allowed is an expense. Transfer to income statement. 35. Discounts allowed. 35. Discounts received. When you transfer it, let's do that. Let me show you that physically. Look at discounts received. It's sitting here. When I transfer it, it's going to come out of here and therefore go onto the credit side of my income statement. And finally, my cost of sales. What do I have? I have 1570 minus 880. Yes. So this is my smaller side. So equals this. What's this? Minus this minus this. And your cost of sales is 690. So that's your cost of sales. So here we are, transfer this to your cost of sales. 690. Technically, this would have been the first thing you transfer. That would be right up there. So you could compare it with revenue. But it doesn't matter. We're just doing the T accounting. So this is now gone. This account, the cost of sales account, is now definitely 100% gone. And we can find out whether we've made a profit or a loss by comparing this side of the income statement and this side. So let's do that very quickly. Let's just see. Right now we have 1075. I'll just write that 0 here, 1075. And here I have 930. So according to this, 930. So according to this, I have made a loss. Yes, I've made a loss. My loss, according to this, is yes, minus this. So according to this, my loss is 145. I'm not sure what your answers were like in class, but you know, we can look at that. But the key point is that I might have missed something going along, which is why we use a trial balance to check. But at least if you can get to this stage and get everything in there, then we're on the right track. Okay, great stuff. Have a go, have a read. This is where I want you to be able to get to. I want you to be able to get to this income statement, transfer everything, find the difference between both sides, and find out whether or not you've made a profit or loss, depending on which side is greater. The revenue side is weaker, is less than the expenses side, as you can see. You can see the sum over here. Okay, great stuff. And I will see you on Tuesday when we have an exam looking at this material. Thank you.